Andrea Gellert serves as OnDeck's Chief Marketing Officer, having led marketing at the company since November of 2012. Prior to joining OnDeck, Ms. Gellert was Vice President of Client Services and Operations at Group Commerce Incorporated, an e-commerce platform for publishers. And from July 2008 to September 2011, Ms. Gellert served as Vice President of Customer Experience and Retention at American Express. Ms. Gellert holds an AB in History and Literature from Harvard and an MBA from the Kellogg Graduate School of Management at Northwestern University. She lives in New York City with her husband and 2 children. Let's give her an Arizona welcome to the stage, Andrea Gellert.
All right, good afternoon, everybody. I'm thrilled to be here talking to all of you today, and not just because it's literally 60 degrees warmer in Phoenix than it is in New York City today, although that has been a benefit. It's been lovely to get some time outside. But what I'm really here to be excited to talk to you about is opportunities that are happening in the financing space. And I wanted to, if I get this clicker right, excellent, highlight the issues that we know that small businesses face by just talking about a customer, a local guy, Dan Gonzalez from Gilbert, Arizona. And he has a maintenance firm called Mojito Maintenance, and he had the great fortune of delivered by hard work, of getting 4 new clients in a fairly quick succession in the last year. And while he was excited and thrilled to get all of this new business, he had an issue, because in order to service his new clients, he needed to get some more equipment. He needed to hire some people. He needed to, find some fund his projects. And of course, he doesn't get paid by these new clients until he does the work. So he had a working capital need. And so he went to his local bank, where he had all of his business banking, had been doing it there for a while. And in addition, most of his new clients also banked at that local bank. And he spent over a month going back and forth with his bank. And his conversation, when he talks about that experience, basically indicated that they were always asking for more paperwork. They were always really looking for a reason to say no, not a reason to say yes. After going back and forth for a month, he got frustrated. He found our company OnDeck, and we were able to get him funding within about 24 hours, 48 hours. What's Dan experiencing? Dan's experiencing what 10 million small business owners are often experiencing. These 10 million business owners are looking for capital every year to grow and thrive. And the situation that they are facing is that traditional lenders such as banks have, and I'll show you a chart in a minute, have seriously decreased the number of loans that they're making on a yearly basis. And that's really because banks aren't set up to make the kinds of small dollar loans that small businesses need, right? They can make a $3 million loan, invest the time, energy, and effort into what you need to do that, and they can make a lot more money on that than they can the $50,000 loan. They just don't have the technology or process to do the $50,000 loan profitably. And so what they end up doing is defaulting to one of 2 options for you as the business owner, which I'm sure you've all experienced. One is they try to give you a credit card, which has limited utility for a lot of small businesses, or they default to looking at your personal credit. And the challenge in looking at personal credit is that there are actually false positives and negatives to that. You may pay your home mortgage on time, but run a terrible business. But conversely, many business owners sacrifice their personal credit to build their business, and the personal credit scoring system doesn't give the business owner any credit for the $1 million business that they're running in terms of how much debt they can service. So that's the situation that we have been in. And you can see that the percentage of business loans that have been delivered by banks has just been decreasing, and the trend actually started pre-economic crisis of 2008. This isn't just a result of 2008. So that's the reality from the traditional lender's perspective. From your perspective, as we've heard all throughout the day, you're busy. Small businesses have 15 different million things going on in your mind at once. And the challenge you face when you think about investing in your business is how much time am I going to devote to looking for financing relative to the need that I have? The New York Fed recently issued a study that indicated that on average, when small businesses went to search for financing, it took you 33 person hours, not lapse time, 33 hours of your time to apply for and seek financing, and often the answer that you got from the traditional lenders was no. Right? So what we've observed is that As small business owners, you just start to opt out. Well, yeah, I could invest $30,000 in a new piece of equipment, but the hassle factor for me of spending the time to look for that, given everything else I have going on right now, just isn't worth it. But there's good news, and that's what I'm here to talk to you about today. Small business owner needs plus technology, plus the increase in data footprint, are creating new financing options for business owners like you. And it's finally being transformed, and I'm going to show you the comparison. So, we've lived in a traditional lender society for a long time with a long application process, significant paperwork, and also a requirement often of heavy collateral. Right? So often business owners will say, yeah, the bank will lend you money if you have money, but that's not the situation that most people are in. And it's being disrupted. Now, interestingly enough, so much of our lives have been disrupted by technology. When was the last time you bought an airline ticket through a travel agent? Or when was the last time you went to a bookstore to buy a book? Financial services, though, is much more complicated, and so it's taken a longer time for the industry to be disrupted, but it is. So there's a whole new crop of online lenders that have short application processes that don't have as much paperwork. They have a data-driven approach. They're focused on the operating needs of your business. They can lend smaller amounts. They can lend to younger businesses. And they often require a blanket lien on the business, but they're not looking for the kind of specific collateral that traditional lenders are doing. Now, that has implications across the board in terms of how much money they're likely to lend and at what cost, but these options are now widely available. When I take you through these different options, you've got to think about it from your perspective in terms of your capital needs, right? Am I trying to open a new business? Do I have a new marketing idea? Am I looking for financing to hiring? And that will really inform which of these types of lenders may be useful for you, right? Because you've got to think about it in terms of how much money do I need? How long do I think I need in order to pay back the financing that I've taken? What's my return going to look like? And what's the impact to my cash flow of any kind of borrowing that I'm going to be doing? And that'll influence the kind of online lender that may be the best fit for you. All right, so let's go through some of what we have here. So the first, I'm going to start with kind of earlier stage businesses and then move up to more mature businesses. Nonprofit lenders, this is a really interesting group of companies, and you'll see on each of the slides I list some of the providers who are out there. And this is really where a business partners with a nonprofit lender for micro and small business loans. And these folks tend to focus on mission-driven lending. A lot of what you'll see here are people interested in lending to food industries. So whether or not it's local organic farmers or Susie's Pickles who wants to sell at the green markets, that's really where nonprofit lenders have filled the void. In terms of payment, most of the nonprofit lenders, right, they're backed by government grants or donations, and so for the most part, they have very small interest payments. They're looking to get their principal back. They're great for startups and micro businesses, and they often offer free mentoring, which can work along with a score counselor to help you grow your business. But clearly, this is meant for smaller loan amounts. It's not ideal for large expansion projects. If you do have a really big idea, crowdfunding has become an excellent platform. If you've always wanted to launch a business, what you can do is go to any one of these sites on the bottom, you post your business idea, and then a network of individuals with money are looking to invest in the next new big idea and support small business efforts. The way that this works, there are really two types of crowdfunding. The first one is donation and purchase-based funding. So this is if you are making like a widget that a consumer might want. And so you have a new idea, for example, for a cell phone accessory, and you're looking to raise $50,000. You go onto maybe Kickstarter, and you find 545 individuals who give you $50, 85 individuals who give you 150, 10 people give you 1,000 in exchange for the product when you develop it, right? Because what you're looking for are the funds to go and actually produce your product. And so they'll say, for every $50 you donate, you get one of my widgets. The second type of crowdfunding is really an investment crowdfunding. And this is where maybe your idea isn't such a consumer-oriented product, maybe it's more of a business service, but it's still a great idea. And here you're looking for investors. So in this $50,000 scenario, you get 10 individuals who invest $10,000, 5 individuals who invest $10,000 in exchange for equity in your business. So you have to be willing to give up equity in order to participate here. The way this works on payment is, some sites actually require you to have an ongoing fee with them while you're in the search mode. And again, what's great about crowdfunding is that it allows you to get in front of a wide network of people who can provide you funding very quickly. And, but that also can be challenging because you really have to be willing to go and pitch your business to a lot of people. And the people you're pitching to have to be accredited investors. These are folks that have been deemed by the SEC to be demonstrated as knowing what they're doing. They're wealthy individuals, they're hedge funds, they're institutional funds. So they expect a certain amount of savvy from the entrepreneur. And again, many projects don't get funded, and some projects will say, listen, I will commit to X amount of money only if you reach your goal, right? So if you're trying to raise $50,000 and you only raise 30 in terms of commitments, you may not get even the 30. So you just have to make sure you're allocating your time. The next area I wanted to talk about is called invoice financing. This is really a modern riff on factoring, which has been around for a really long time. Anybody who's in the wholesale business and who depends on invoicing for their payments, probably knows about factoring. But historically, factoring has really been limited to larger companies doing business with larger companies. The new invoice financing companies have a much broader point of view, and they will accept a lot of the different invoices, and they have a very streamlined process. You go online, you upload your invoices, and determine how much of them you want advances on. And the way that the advancing works is it's one of two ways. Let's say that you have invoices that are worth up to about $100,000. One company will advance you 100% of that and then just charge you an amortized fee schedule for the interest. Another company will advance you $85,000 of that and then hold off the $15,000, 85%. So on a $100,000 invoice, it would be $85,000, and then holds off on giving you $15,000 until they get paid, right? Because you're selling your invoices to them. And once they get paid, they will net out their fees from that and then send you the balance of what's left. This is really good because you can receive cash quickly instead of waiting on your invoices. You may not even have the opportunity to do that, right? Because if you need to, let's say you sell sweaters to you manufacture sweaters that get sold to a store, you're not going to get paid until those sweaters are delivered, right? You actually need to front the cash in order to get those sweaters made. And so it's not necessarily just a short working capital time. You've got to make those sweaters 6 months in advance of actually getting paid from the company. So again, these are typically for larger, more established businesses. Some of the new invoice financing companies will actually determine what your fee is based on how well they know who the buyer is. But again, much more flexible than the traditional forms of factoring. Now, the largest group of the new online business loan is really the term loan sector, and this is where my company, OnDeck, plays. As you can see, there are a ton of different players here, and that just speaks to the fact that the great thing about technology and innovation is that there doesn't need to be a one-size-fits-all loan out there anymore. What can be difficult about that is that all of these companies are different, and so like some of them, for example, Apple Pie Capital actually is a marketplace. So you say that you want $40,000, they bring some investors to lend you the $40,000 through their marketplace functionality. Others are more segment-oriented. So StreetShares is really interesting. They really focus on the veteran small business owners. You'd think that the Veteran Administration would provide a lot of support to veteran-owned small businesses. It turns out, and we've heard this from our veteran small business owners, turns out they don't. So that's where StreetShares is focused. You have some like OnDeck that are focused on shorter term loans for sort of smaller dollar amounts. So we go 3 to 24 months, 5,000 to 250. Others, such as Funding Circle, are really focused on longer term loans with 300,000 plus term loan size. We all kind of work very similarly. You go on a website, you have an application, there's an application review. Some of these companies have people to talk to, some of them don't. We do. We find that most small business owners want to talk to somebody before taking out a $50,000 liability. And then the funding happens quickly, right? So this is what you're really getting. The process is quick, the funding happens quickly. It can be anywhere from a day to 2 weeks, and that will really depend on what kind of data we can find or not find about you, as well as how much money you're actually looking for, as well as the company that you choose to work with. So one thing I think is important to understand is that as there's this new crop of lenders, it's important to understand how the approval rate and the pricing dynamic works. So basically, when you think about traditional lenders like banks and factoring, they keep their approval rates pretty low. And they can do this because they're making larger loans. The top SBA lender of the 7A loans, their average loan size is between $350,000 and $400,000, right? And because banks have such large distribution, they can make a lot of those kinds of loans and keep their default rates really low, right? Because they're investing an enormous amount in the process to make sure that you're going to pay for it, and they ask you for collateral for it and the like. Because they can keep their loss rates low, their default rates low, they know who's going to pay them back, they can keep their interest rates to the borrower relatively low. And that's the dynamic that you see as a borrower, right? So as a borrower, it's very easy to lend money, right? It's actually, the trick is making sure you can figure out who you're going to lend to, who can pay you back. And so what you see here is that online loans are casting a wider net. Online lending companies have a much higher approval rate than traditional lenders. But because that's really dispersed amongst a broader range of businesses where they don't have the requirements of the paperwork as well as the collateral, they're going to charge you more. And I'll talk you through a little bit about how pricing can look and feel in this online environment. At the very highest end is a group that you may see called Merchant Cash Advance. Any of you who accept a lot of credit cards probably know about these guys. They've been around for a while. And they cast a really wide net. And as a result, there's a lot of volatility in their portfolio, and so they charge quite high. The reason why I have this dotted line here is that, one of the things, we're a bunch of new companies in this space, and so we're not at scale yet, right? And the more a new company can go to scale, the more they can cover their fixed costs and start to bring pricing down. So companies like OnDeck, we brought our pricing down every quarter over the last 8 quarters, and we're still not a profitable company yet. So we're trying to balance that, and obviously our pricing to our customer reflects that current dynamic in our business. So this is an interesting game we often play. How many of you, just raise of hands, would prefer a 67.5% APR instead of a 22.5% APR? If somebody said for 10,000 bucks, 67.5 versus 22. Nobody? 67.5? A couple people. Most people are like 22, of course. All right, conversely, on that $10,000 loan, how many of you would rather pay $1,500 of interest versus $4,800 of interest? 1,500? 1,500, right? All right, well, let's see how this plays out. So if you borrow $10,000 over 6 months, that's a total interest cost of $1,500 to you. Now, 6 months turns out to be, because of the way the math works on APR, a 67.5% interest rate. And that's really because of the math around compounding interest and then annualizing it on a short-term, fully amortizing loan, right? So it's not like you're rolling it over on a credit card balance. It's just that you're paying in equal payments over 6 months. And when you do all the math to make an APR for it, it's 67.5%. Conversely, if you borrowed that same $10,000, but you did it over a 4-year period, that's $4,800 interest cost, and it's a 22.5% APR. So the thing you have to keep in mind is what is the sort of value of and return on your investment, right? If you can do an inventory turn, which pays you 200% on a 6-month period, then a 67.5% APR is not so bad, right? And you've got to think about, what else could I do with that $1,500 in 6 months? Could I do something else with that $1,500 that would give me as much return as this $10,000 investment? Conversely, on the other side of the house, if you think that this $10,000 that you're borrowing is going to take you a lot of time to recoup because of the nature of the investment, then yeah, you may want to space out that payment over 4 years. And obviously this gets magnified if you're dealing with a $10,000 borrowed over 6 months versus maybe $100,000 borrowed over 4 years, right? But that's the dynamic that you see. APR is kind of a funky number when you start to get into short-term loans. All right, so just to summarize this, what we see here on online business loans is that we have fixed interest and payments. They're auto-debited from your account, generally daily or weekly. We've talked about approvals, and the whole process can be extremely quick. And the decisions are based on your business operations, much more so than on your personal credit score. They're ideal for business opportunities with an ROI. As you saw that approval and pricing dynamic, this isn't money just to have lying around to sit there because it's not cheap financing. In terms of the considerations, none of these companies lend to startups, and they're not available for all industries. There's just some of the data footprint, right? If you get paid every 6 months from 2 or 3 different customers, a daily or weekly debiting loan product is just not going to work for you. And the loan amounts and terms, vary by company, as I was saying. We don't all offer the same thing. The other thing on the industry front that's important to note that I don't think most of these companies lend to the vice industry. We have an office in Colorado, so we get asked about that all the time. All right, if I've now confused you with all these different options and you're thinking, I really don't know where to start, I'm not exactly sure which is the right type of lender for me, and I have all these great ideas, I know I need to do all this financing to help my business, I recommend a loan matching site. And so I've listed a variety here on the bottom. And that's where you go to a loan matching site. They ask you for some information on your business, and you, as well as a little bit on your sort of credit history and background, and then they'll filter and suggest a variety of lending options for you, which is super handy. It won't cost you anything to use the site because they earn referral fees from whomever you get the final loan from. It allows you to get in front of a lot of significant number of lenders very quickly. But you still have to apply with each lender, right? So if they give you an option for 10, they then don't do the legwork to do all the application work. You still need to do it on your own. And they will often still recommend traditional lenders for you, which could be a good option, but might not always be the best option for you. And then finally, something to watch out for, they may connect you with a broker and not an actual lender. And that just means there's another middleman in the process who might be taking out fees, which will ultimately impact the rate that you pay. Okay, so we've gone through all the different options. I thought it would be helpful to have some sample financing scenarios, so just to see how they can apply. So let's say you want to open up a new franchise location and you need $300,000. This is where a loan matching site could be good for you, or possibly an online business loan marketplace that tends to focus on longer-term loans, right? Because $300,000, you're going to need some time to pay that back. You decide you want to develop a new product. Crowdfunding is a great option for you. You have an opportunity to buy discounted inventory in 4 days, and you need $75,000 to do it. This is where an online business short-term loan could be great. You want to manage your receivables gaps, and there are two options here. One could be invoice financing. The other one, and we see this play out a lot in the healthcare industry, we have a lot of doctors, dentists, healthcare practitioners coming to us, is a short-term business loan. And that's really because insurance companies don't pay healthcare folks back in, anything less than, 90 days, 60 days, 90 days. And when, a doctor thinks about this in terms of the opportunity cost of their time, the idea of spending all that time going to a traditional lender to get funding when every hour out of their office is in, billable hour time, it's not worth it to them. So they often opt for speed and convenience and are willing to pay a premium for it. And then, you want to launch your first marketing campaign in your Susie's Pickles and you need $5,000. This is where a nonprofit lender can be extremely helpful. I want to close just by saying, first of all, thank you. And secondly, I've in sort of 20 minutes tried to compress a lot of information about all of this financing. And through our partnership with SCORE, you can take a look at the Center for Financial Excellence to get more information. And also OnDeck, because we hear that from business owners all the time that there's no great one place to find out all this information. We decided we would just do it ourselves and launch our own site. Take a look at businessloans.com. We have information about both traditional and non-traditional types of financing, written in what we hope is a clear and concise way. And I trust that if you check out the site and have any comments and feedback on it, you will get them back to me. So thank you so much for your time today. Really appreciate it.